Welcome to the deep dive. Okay, so today we're digging into the Q3 2025 results for a big global snack company.
That's right.
We've got the source material right here, and we're going to figure out what's really driving the market for, well, everything from biscuits to chocolate. Our mission, cut through the noise, get the signal, and understand, the real cost behind these snacks.
And there's definitely a lot of noise in these results. This isn't just your standard earnings report. It's really a study in conflict.
Conflict? How so?
You've got these really powerful pricing actions hitting head-on against severe, frankly unprecedented commodity inflation, especially one key ingredient.
Okay, let's get that core tension out there right away then. On one hand, pretty solid top-line numbers. Organic net revenue growth up 3.4% for the quarter, year-to-date 4.0%.
It's good on the surface.
But then you look at the bottom line, adjusted earnings per share. A sharp decline. Minus 24.2% on a constant currency basis for Q3. So how does that happen? How do you get solid revenue growth and, well, a profit collapse in the same quarter?
That is the question these sources answer. And the answer is, well, revenue was basically all driven by pushing prices higher. A win for the commercial team, you could say.
Okay.
But those input costs, they just surged. They absolutely decimated the profit. And cocoa, that's the undisputed story here. It just made profitability almost impossible in Q3.
All right, let's unpack that revenue side first. They pushed pricing up, what was it, 8 percentage points?
A full 8 points, yeah. That's pretty aggressive.
So what happened then? I mean, what was the immediate fallout? How did consumers react? Where do we see that in the volume numbers?
Well, you see it right there. That aggressive pricing led straight to a pretty substantial drop in volume and mix. Unfavorable VM, as they call it.
How substantial?
Globally, it was down 4.6 percentage points. Minus 4.6.
Wow.
Yeah. So consumers are clearly pushing back. They're buying less, maybe trading down to cheaper options, shifting channels.
So the company's getting the dollars through price increases.
But they're sacrificing actual volume, fewer snacks being sold. That's the trade-off.
And it seems like that pain wasn't spread evenly across the globe, was it?
Not at all. If you split it regionally, developed markets, that's about 61% of their revenue, they only saw 1.2% organic net revenue growth.
Only 1.2.
Yeah, and that reflects a really steep volume mix decline. Minus 4.5 percentage points there. And the sources even point out, in North America specifically, the biscuit category's value is actually declining faster in the last 3 months compared to the first half of 2025.
So people are really pulling back on staple snacks in developed countries.
Seems like it. Meanwhile, emerging markets, which are, 39% of revenue, they actually held up better.
Okay.
They saw genuine resilience. Organic net revenue growth there was plus 7.1%.
That's pretty strong.
It is. But, and this is critical, even those emerging regions still had a significant volume mix drag, minus 4.7 percentage points.
So even where growth looks good, fewer units are being bought.
Exactly. The pricing pressure is everywhere. It's just hurting volume less in those higher growth economies, maybe.
And speaking of rough patches, Europe looked particularly bad on the volume side.
Yeah, Europe had a really severe volume mix drop, minus 7.5 percentage points.
Ouch. Any reason given?
Well, the report partly blames a drag from a heat wave impacting consumption.
A heat wave? Huh.
Yeah.
You really can't control everything.
Nope, definitely not the weather. So, given this sort of widespread volume drag, especially in developed markets where people are hunting for value, what's the plan?
Right. What are they doing about it?
The strategic response seems to have two main parts. First, they're trying to shift the portfolio. More new innovations, growing their premium stuff, and also better for you or BFY offerings.
Healthier options, maybe higher margin things.
Probably both.
Yeah.
Second, they're really leaning on something called revenue growth management, RGM.
RGM. Okay, for listeners maybe not in the industry, what does that actually mean? What are they doing?
RGM is basically using data and analytics to be really smart about pricing and promotions.
Yeah.
It's about making surgical adjustments,
Like targeted discounts or specific pack sizes?
Exactly. Especially as consumers shift towards club stores, value retailers, e-commerce, basically anywhere they think they can find a better deal. They're trying to manage that shift carefully.
Got it. Okay, that managed at the top line, but it brings us right back to the profit destruction. Despite that 3.4% revenue growth, adjusted gross profit growth fell sharply, over 21% down in the quarter.
Yeah, minus 21.3%. And that flows directly to that, as you called it, brutal EPS drop of minus 24.2%.
That really is a margin crush.
Absolutely. And the driver was just overwhelmingly higher input costs. Raw materials mainly.
What kind of costs?
It was across the board, really. Dairy, edible oils, packaging, nuts, energy.
Hmm.
But we have to focus on the main culprit,
Cocoa.
cocoa. The price shock there was just immense.
Yeah, the source material gives some pretty stunning numbers to put this in perspective for you. Back in 2023, the average London cocoa SBOT price was around £2,700 per ton, give or take.
And the forecast for the average for this full year, 2025, around £5,900 per ton.
Wow. More than double.
More than double the cost of the key ingredient for their entire chocolate business in less than 2 years. It's a seismic event. It just destabilizes the whole P&L.
Okay, so how does that financial earthquake translate down to the category level? How did it hit the chocolate segment specifically?
Direct impact. You saw high organic net revenue growth in chocolate, plus 8.2% in Q3. But again,
Let me guess, all price.
strictly due to that cocoa-led pricing. And the flip side, that pricing caused a massive volume mix decline in chocolate alone, minus 10.5 percentage points.
Minus 10.5% volume drop in chocolate. Okay, that confirms what you sort of feel in the stores. Consumer elasticity is really being tested.
Totally stretched. It led to much higher price gaps in the chocolate market, and that forces consumers to change behavior. The report specifically notes a, quote, shift to smaller formats in chocolate.
Ah, so people still want their chocolate fix.
But they're buying smaller bars, smaller packs, trying to manage that out-of-pocket cost. Shrinkflation from the consumer side almost.
And this financial stress, it's having real tangible effects on the brands themselves, right? There were impairment charges?
Yes, non-cash impairment charges. $33 million in Q3. And these aren't just accounting entries. These are actual brands.
Which ones?
2 biscuit brands in Europe, 1 biscuit in EMEA, Asia, Middle East, Africa, 1 candy brand in Latin America. They're being written down because the current market conditions, the cost structure, it just doesn't support their previous valuations or strategic plans.
They basically broke under the pressure.
Essentially. And the warnings don't stop there. Beyond those impairments, the sources flag 5 other brands where their fair value is getting dangerously close to their book value.
How close? Less than a 10% buffer, they say. So this cost environment, it's volatile, it's persistent, and it's forcing a really serious look across the entire portfolio.
Wait a second. If 5 other brands are already flagged like that,
Yeah.
does that maybe suggest that the current pricing strategy, while boosting revenue now, isn't really solving the fundamental cost problem? Maybe just kicking the impairment can down the road, sacrificing long-term brand health for short-term margin.
That's a really sharp point. It absolutely suggests a tremendous challenge ahead. Pricing has propped up the revenue line, yes, but it's actively hurting volume and forcing these tough asset reviews. Which leads us nicely into their longer-term strategic moves. They seem to be making some big bets on future efficiency.
Okay, let's turn to those strategic moves, because despite all this turmoil, they are still returning cash to shareholders. Year-to-date free cash flow was $1.2 billion.
Pretty healthy.
And they returned capital, $1.9 billion in share buybacks, $1.8 billion in dividends. And they're still active on M&A, right? Like that China acquisition. Yeah, they bought Everth. It's a cakes and pastries maker in China back in November 2024. That already added about $87 million in revenue in Q3 this year. So targeted growth is still happening.
The big news seems to be on the internal side, this massive tech investment.
Absolutely huge. They got approval for $1.2 billion in funding. That's billion with a B. For a multi-year global transformation program. ERP systems, supply chain systems, the works.
$1.2 billion. When's that supposed to be done?
Expected completion is by the end of 2028, so it's a long-term play.
That scale, $1.2 billion, aiming for 2028.
That feels like a signal, doesn't it?
Okay.
Is this basically them admitting that short-term fixes aren't enough and they need a fundamental structural overhaul to handle these kinds of long-term commodity shocks?
I think that's exactly the read. They're recognizing that true systemic integrated efficiency is probably the only way to really protect margins against this kind of volatility in the future.
Speaking of volatility, the report touches on some specific geopolitical and operational risks, too.
It does. For instance, the situation with their Russia operations. Right. What's the status there?
Well, Russia actually generated 3.7% of their consolidated net revenue in Q3. That's up a bit from 2.9% last year. The company says they're maintaining operations for food continuity reasons, but they clearly acknowledge the ongoing risk. Potential asset loss, maybe even deconsolidation, depending on how things evolve geopolitically.
It's a tricky balance, and there was also a technical accounting point about high inflation in Argentina.
Correct. Because Argentina is considered highly inflationary under U.S. accounting rules, GAAP, they've decided to exclude the impact of pricing increases over 26% year over year from their main non-GAAP growth measures.
Why do they do that? Just pull Argentina out like that. Does
Yeah.
that 26% number just show how wild things are there?
It does show the volatility, yes, but the exclusion is really about providing clarity. When cumulative inflation hits 100% over 3 years, which it has in Argentina, the accounting rules basically say local price hikes are more about currency devaluation than real business growth. So pulling it out gives investors a cleaner picture of the underlying organic performance globally.
Got it. Makes sense. And we should probably also mention those pension settlement losses from this year.
Yeah, important context for the full financials. 2 big non-cash hits in 2025. $282 million related to settling the U.S. salaried pension plan and another $54 million for Canadian plans. These are basically from converting pension obligations, often through buyouts.
Okay. So summing up the outlook then, they updated their forecast for the full year 2025, still expecting 4% plus organic net revenue growth,
Driven by price.
but now projecting around a 15% decline in EPS. So the profit pain continues for the full year. But what about next year? What's the light at the end of this cocoa-dusted tunnel? They seem optimistic about 2026.
They do. The key phrase in the outlook is that they are expecting on-algorithm EPS growth for 2026.
On algorithm, meaning back to their normal target growth rate.
That's the implication. And this expectation really hinges on one critical thing. They believe cocoa prices will be deflationary compared to the crazy peak we saw in 2025.
So they're betting on cocoa costs coming down significantly. Have they locked any of that in?
Yes, and this is crucial. They've already hedged the majority of their expected cocoa needs for 2026.
Okay.
So while the futures prices for 2026 cocoa are still pretty high, around 4,400 pounds per ton, which is way above historical levels that hedging gives them visibility, it protects them from further spikes, at least for the bulk of their needs.
So the hedging is the buffer. It allows the price increases they've already pushed through this year to finally flow through to the bottom line next year, assuming costs stabilize somewhat.
That seems to be the core strategy. Lock in costs that, while high, are lower than the 2025 peak, and let the existing pricing deliver the margin recovery.
Okay, so let's try to synthesize all this. These Q3 results, they really show extraordinary pricing power in action and real strength in emerging markets.
Definitely. But they also just perfectly illustrate the brutal financial impact when a major commodity cost goes wild, especially if you're not fully hedged.
Right. That unhedged cost exposure created a margin crisis. And it's forcing real changes, pushing consumers to smaller chocolates, writing down brands.
Fundamental shifts.
So what does this all mean for you, the listener?
Well, the path to profit recovery for this company next year, it isn't really about suddenly selling way more cookies.
No, not primarily.
It's largely dependent on global cocoa prices actually stabilizing, hopefully easing off that 2025 peak.
Yeah.
And it also depends on those big multi-year strategic investments in efficiency starting to pay off.
Exactly. And maybe here's a final provocative thought for you to chew on. The company expects cocoa to be deflationary in 2026 versus 2025. Okay? But that projected futures price, around 4,400 pounds a ton, it's still drastically higher than the roughly 2,700 pound level we saw just back in 2023. Still historically very high.
Very high.
Yeah.
So given that, and remembering those 5 other brands already flagged as being close to impairment, what happens if this relief in cocoa costs isn't quite enough? If 4,400 pounds is the new normal, and it's not enough to hit those aggressive 2026 growth targets, what might that mean for the actual size and shape of their core brand portfolio down the road? Could we see more brands under pressure?
A challenging thought indeed. The long-term viability in a world of permanently higher costs. Great insights today. Thank you for walking us through this financial drama.
My pleasure. It was quite a quarter.